Good to be here. I've just landed actually this morning from London. I was over there seeing investors. I've brought the London weather with me seemingly, so apologies for that. The theme of this presentation that I'm talking through today is what's under the hood. And the reason I want to talk about that is that private credit, as everyone knows, has grown. And if you think about the growth in that asset class, what's happened since the year 2000, so over a 25-year period, we saw a growth in that asset class from 50 billion US dollars to $3 trillion in size. And that's a significant amount of growth. The growth especially came from 2010 onwards, post the financial crisis. Now, if you break down what actually happened, private credit, if you go back into the 2000s, actually meant special situations and opportunistic credit. It was the world of the unbanked, things that banks didn't want to do, risky deals, things that had gone bad. It would go out to firms that would do things like recapitalizations and restructures. My background before building the private credit business at MA was, in fact, as a restructuring person. I was a special situations investment banker in the dark side of credit, doing those kind of workouts. But the growth in the asset class actually came from performing credit. It's the dark blue line you can see on the slide here. And that is in finding things where banks, because of regulation, market structure changes, and so on, couldn't actually provide credit. Now, this thematic post-financial crisis was so substantial and there was enough capital in the space that it was really a rising tides lifts all ships environment. If you were just out there doing these things, you found good opportunities. But now things are changing a little bit. And if you think about the best of private credit being things that banks used to do, but they can't do anymore, then you flow that through to a manager. What does it mean? There's 6 things I think you need to think about in private credit managers. You need alignment. We'll talk about that a bit more later. A proven track record, of course, a sort of hygiene factor, disciplined underwriting. Really, selective investment execution, meaning we like to say avoiding losers, not picking winners. We're in the world of credit, meaning we're making loans. We don't want them to go bad. You need to have big diversified portfolios and you need to know what to do when things don't go to plan. That's what the building blocks of good private credit are. Now, I said we're moving away from this rising tide lifts all ships environment. And there's a lot of questions being raised. I mean, private credit, as you heard in the opening, is the hot topic today. It's pretty incredible that credit's just the business of lending is so topical. But what you're seeing is questions being raised, not necessarily about the performance of the assets, but whether or not investors actually know what they're exposed to. Lending is a spectrum. There are good loans and there are bad loans. If you're investing in a lending asset class, you need to know what you're exposed to. And so I think that what's going to happen in the next couple of years is that we're going to move from that rising tide lifts all ships environment where you could go out and make loans in a fairly benign environment and earn pretty good returns to people focusing on what they actually have exposure to. Do I have the good or do I have the bad, or am I somewhere in between? And how do I know? The question is, how do you actually know in this asset class? Because you've got a whole bunch of people going around and they're saying things like, hey, I'm running a private credit fund. I can deliver you 8, 9, 10% returns. And that sounds pretty great, 8% returns in what's meant to be a secured and defensive asset class. The thing is, when you look under the hood in some funds, you see things like very concentrated positions, covenant light lending. That is no protection lending. PIK loans, meaning loans that accrue rather than cash pay. So where's the return really coming from? You also see things like amend and pretend. Loans default, you amend it, you say now they're performing again, you keep rolling it. It's the old thing of a rolling loan can't go bad. You see hidden fees, poor governance, misaligned incentives. And the problem is at the moment, it's really hard to compare to products. That really is a major issue in the asset class. People need to know what they're investing in so they can understand, where does this product sit on a risk spectrum? What kind of returns does it generate? How is it generating those returns? And the only way for that to occur is for there to be the right type of disclosure and transparency. Now, how you should think about disclosure and transparency, I believe, is in 3 layers. The first layer is pretty basic, and that is, what is in my portfolio? That means how diversified is it? What is it? What types of lending is it? Are they diversified? Are they going to give me the consistent income, capital preservation, non-correlation features that you should get from being in a lending asset class? And do I know the features of my loans? That's the really sort of hygiene factor that has to start with. And there are good and bad funds in that respect. The next layer down is even more important. This is the risk-adjusted return transparency. That means, can you tell from the disclosure what type of returns you're getting per unit of risk, the risk you're taking? What's the performance characteristics of the loans and what has it been over time? What are the lending metrics? This is saying, how do you get to the returns? You heard earlier, or you saw on the slide earlier, those 8% returns, say roughly 400 over cash or thereabouts. Where are they coming from? Because ultimately, if you're in a private asset class, what you should be getting is a premium relative to the liquid alternative of that asset class. And so you need to know, am I getting that premium relative to the risk, or am I just taking more risk or different risk? And then the final layer, this is really important, is structural and governance transparency. And that's about not just what's my investment philosophy, but what sort of frameworks, protocols, governance do I have in place to make sure that the processes through which the portfolios are generated and the returns are earned make sense. This is the kind of transparency that's needed in order for investors to understand that question of what's under the hood. So what I want to run through is a couple of examples of what I think good disclosure looks like in this respect, where the industry needs to go, and hopefully we'll see that develop. And what I hope it does for allocators like yourselves in the room is to help you think about, when you're making decisions about investing in a private markets asset class, in particular private credit, how do you actually get the good and avoid the bad? What are the types of questions you need to ask? What are the things you need to focus on? So let's start, with that first layer of transparency, portfolio composition. The first thing I say about this is, if anyone can't tell you what's in their portfolio, and I know you hear things in this asset class about we're under NDA, we're doing private lending. I mean, it's just absolute rubbish. If you cannot disclose what's in the portfolio, that's obviously red flag number one. But just knowing what's in the portfolio at a high level isn't enough. Any decent fund manager should be able to do something like what's on the page here and say, okay, show me what the portfolio looks like in its shape. How granular is it? What are my average position sizes? How many positions do I have? What's the largest position versus the smallest position? Do I have tail risk, and so on and so forth? Now, a few people do that. Now, that's it. That is a basic type of transparency that's needed, but it's got to go further. You've got to be able to do a whole bunch of other things. You need to talk about borrower concentrations. I could have lots of loans, but if they're all to the same borrower or same borrower group, that's not going to be very diversified in its practical effect. Now, I know many of you might laugh at something like that, but you have seen examples of funds with 70% exposure to one borrower group or to one sponsor. We saw a major fund, UBS O'Connor, over in relation to a situation in the US, First Brands, which is one of these fraudulent situations in the headline. They had a fund with something like 30% exposure to that one borrower cohort. How can that happen? So it's not just the number of loans, it's the groups, the aggregations, the types of asset classes as well. If I have lots of loans to many different borrowers, all in the same industry, I'm going to face that same issue of over-concentration. They're the kind of things you need to see. You also need to see things like credit rating. What are the loans actually used for? Are they ordinary course term lending? Is it something riskier like development finance? What's the spread of that? The security features, liquidity. We're seeing all these headlines at the moment about funds, lockups, redemptions. What's the actual liquidity feature and the distribution of liquidity in the book? Can it generate self-liquidating features or not? All these things can be disclosed, and they should be disclosed by any good manager. Now, I just want to dig into a couple of those things I read. So one of the things I said was around disclosing the credit sub-segments. You heard a lot, if you go back 2 or 3 years ago, when a lot of global private credit managers will come to Australia and they'd say, well, Australia's a pretty small market. We're in the US. It's a lot bigger market. So funds in the US will have more loans. Instead of having 200 or 300, maybe you'll have 400 or 500. Okay. But actually, they're all to just software and technology borrowers. This has actually happened in some US BDCs. You're seeing 22% on average exposure to borrowers that are owned by private equity. So they're leverage finance loans, already a little riskier. And then on top of that, they're in one sector. That isn't good portfolio management. And if you looked under the hood, you say, okay, there's lots of loans, but they're all actually exposed to the same thematic. If you compare that to what it looked like in the liquid credit markets, in investment grade or high yield bonds, it was about 3% exposure, leverage loans 13, US BDCs 22. So it's just got too much exposure. In fact, in most Australian exposures, it's something like, I know ours is 2.9. Most Australian private credit has lower exposure to software technology borrowers. Software and technology borrowers, it's all over the headline and everyone's talking about AI and everything. But if you're lending to a business that's mission critical, system of record, recurring revenue, high margin, cash generating, that is actually a good loan. The thing is, you probably can't go and find too many of those loans. And so if you've got too much concentration to one thing and then the wind turns, you're exposed. This issue in the headlines in relation to software and technology borrowers isn't actually an issue of whether or not the loans themselves are good. It's actually an issue of portfolio management, and that is people have too much exposure to one thing. If you had the right disclosure around portfolio, then people could have made that assessment. This same way of thinking applies actually to private credit as an asset class. Globally, and certainly in the press at the moment, private credit is almost synonymous with lending to private equity buyouts. Leverage finance, sponsor-backed lending, there's lots of names for it, but basically it means private equity companies buying something and people are lending to it. Now, leverage finance can be good, a good way to a good asset class to be exposed to. But it's not the whole lending universe. If you look globally, I've got these stats here on the left from a combination of the Federal Reserve and FS. Leveraged corporate credit is about 15% of all lending. So there's 85% of the rest of the possible universe of lending that you can do. If you think about a bank has a balance sheet with lots of things on it: home loans, car loans, business loans, equipment finance, all sorts of things. That's the whole world of lending. It's not just funding leveraged finance. And so you need to be thinking about the broad-based spectrum of what you could have exposure to. And that goes to portfolio disclosure as well. It's not just the kind of industries you borrow in, it's the actual sectors, the asset classes that you want exposure to as well. The spectrum of private lending is loans secured against physical assets. That could be real estate, infrastructure, a range of other assets. It can be asset-backed lending, meaning financing whole portfolios of loans, either directly or in partnership with banks or non-banks. These are real-world loans, and you find areas where it's no longer efficient for a bank to lend anymore, and you can step into that void. And then finally, yes, it can be corporate lending, and those corporate loans can be to private equity buyouts. They can just be to ordinary companies out there in the world. That's the whole spectrum of lending. You want exposure to all of it, but most importantly, you want to know what you have exposure to. And that goes again to the disclosure points. So I know it seems like a bit of a hygiene factor, but it is something where really the private lending industry needs to evolve. And hopefully we'll see progress in that respect. Now, the second layer of disclosure, though, and this is really important for investors and allocators, is where is my return coming from? Most decent fund managers will put information out there about their portfolio. So you can say, okay, red flag, if you're not getting that kind of disclosure, don't invest. If you do, now I at least know what I'm exposed to. But the next thing that's really important is where the return's coming from. So historically, when people talked about private credit, they would often say things like, well, I can get equity returns through debt. Now, that is one type of private credit, but I actually don't think it's the best type of private credit. Either way, you want to know. I think we've got to move away from this idea of private credit being, oh, you know, I could invest in bonds or high yield bonds, but I can actually get equity-like returns in this other alternative asset class. I guess if you looked at it from 2004 to 2023, as T. Rowe Price did here, I think it was originally based on JP Morgan, this data JP Morgan puts out as well, actually. But anyway, you'd see a graph like this where you say, okay, well, you're getting those kind of higher returns, you're getting lower volatility. It's a better place for your defensive portfolio. But actually, it's just a wrong framework to think about how you should be allocating into private credit. The better framework is something that looks like this. Private credit is a spectrum. There are private loans that are investment grade. There are private loans that are sub-investment grade and high yield. And then there are private loans that actually have equity-like characteristics, but of course that means they have higher risk. It's a spectrum from lower risk to higher risk. And the premium you get for being in a private asset class isn't free. If you're investing in a private markets alternative, whether that's investment grade private credit, high yield private credit, combination of both of those things, or private equity, or anything else by another name, you're getting a premium for a couple of different things. The first one is you're trading off some liquidity. It doesn't trade every day. There's only certain ways to come in and out. Now, there might be ways to bridge liquidity gaps. We can talk about that. You can look at things for structures like listed trusts and so on. But the point is there is less liquidity. The next one is, though, that you're going to get a premium for the fact that there's proprietary origination in the generation of these assets. You have to go out there, source them. You can't just you open Bloomberg and buy these assets. You actually have to produce them, do the work. There's a whole bunch of complexity around that. That's what you get paid for. Now, the idea is, of course, for investors to be able to capture some of that premium by participating in these assets, but you want to do it on a risk equivalent basis. You want to say, do I want investment grade privates where I'm going to get a certain amount of return? It's going to be lower than you get for a high yield or sub investment grade alternative, and it's certainly going to be lower than you get for an equity like alternative. That's the framework to think about it. It's not equity returns through debt. It's what risk profile do I want and what premium do I need to trade off some liquidity and to be in something a bit more proprietary. To make that assessment, you need disclosure around where the returns are coming from. So you need to know things like at the loan level, of course, what's the loan to value ratio, debt service coverage, the lending metrics, yes, the investment performance, but investment performance in terms of gross to net. What's happening in the underlying portfolio? Am I using leverage or not? Are the loans performing or not? Are they high yield loans defaulting all the time, getting back to a certain return? Or are they loans that are actually lower risk in nature and performing more consistently? And then you also need to understand changes in relation to the loans. There is the ability in private lending for you to change the loan. So the loan, your borrower faces difficulties, you amend it. You could amend it to enable them not to pay cash interest, but to accrue some of their interest. Could amend the terms so that they no longer breach a covenant. They hit a covenant, amend it and change it. That sort of activity should be disclosed. And if it's disclosed, then you can understand what's actually happening in the underlying portfolio, and it helps you to understand where the returns are coming from. There should also be basic things around like what's the level of arrears in the book, what are the default rates, and for things that are defaulting, what's being done about them. Banks have been putting out good disclosure on their portfolio for many decades, especially post-financial crisis. All those risk disclosures they put out, the portfolio composition, that's really important. I also think you should have loan-by-loan disclosure. I won't make any friends amongst peers by saying that, but I do think you should actually have that kind of thing in the portfolio. Here's why. So if we just look at two loans, I'm just using two illustrative loans. They're corporate loans for simplicity. Loan, imagine they're both loans to borrowers on a senior secured basis. 500 over base rates. So at the moment in Australia, that would be about 9% return. These two loans are not the same. So the question is, what are the characteristics of the loans? If loan number one is at 4.5 turns of EBITDA, that's roughly where you're doing corporate loans, when you're originating a new corporate loan in private lending in Australia, roughly what the debt to EBITDA metric is, right? That's a metric of gearing of a corporate.
If you look at corporate loan number 2, that's at 6 turns of EBITDA. That's roughly where, if you're in, say, the US or in parts of Europe, that's probably where you're originating loans, so around 6 turns of EBITDA. These loans, if they're generating the same return, then I'm getting different returns, a different margin per unit of gearing, which is a metric of risk. It's not the only metric of risk, but it's one of them. And so these are the kind of questions you need to be able to ask. It's not just what's the loan yielding. It's, well, what risk am I taking to get that yield? Because corporate loan number 1 is giving me roughly 110 basis points of return per unit of gearing. Corporate loan number 2 is only giving me around 80 basis points. And that's because they've got different leverage profiles. In fact, I don't know what's going on with that graphic, but 1.3 times better margin per unit of gearing. Even if you change this, if you said, well, corporate loan number 2 has now a higher yield. So let's imagine, it's got more gearing, so we add a little bit more margin. Even if it was yielding 600 over, because it's 6 times EBITDA, it's actually still worse per unit of gearing from a risk perspective. So that goes to that question again of like, what's my spectrum of exposure here? What's my spectrum of risk, and am I getting the right premium? And then you need to be able to aggregate that up at a portfolio level, because it's not just debt to EBITDA and corporate loans. You could think about loan to value ratio, credit ratings. There's a whole bunch of risk metrics that you could look at, but you're always looking at return per unit of risk, and you need to find the right metrics of risk that matter to you as an investor or allocator. But when you roll that up then to a portfolio level, you want to be able to see, okay, I understand how the portfolio yield's being generated. And then how's it flowing through to my return? And I want to illustrate this using this first fund here, fund example. Most private credit funds at the moment, if they're in the more moderate return spectrum, probably delivering 4 to 4.5 percentage points over base rate return. So I'm just going to use 4.25 as the midpoint. So to generate 4.25% returns in a private fund, the portfolio probably needs to be yielding about 5.5 over base rate, so it's yielding 9. After some fees, it's paying 8.35 roughly. That's diff 425. Let's just assume that's the case. Now, this first fund on the left, Fund 1, it's done that. Hasn't been any losses and impairments. Hasn't used any leverage, and it's paid 425 over. Fund 2 also pays 425 over. But it's using leverage. So the portfolio is starting at that 9% yield. It's getting up to about 11 or 12 by using gearing, by using debt from banks or others. Then there's some losses in the portfolio, more fees, and you get back to the same level. Now, this is, of course, illustrative, but it's illustrative of something that's very real out there. There's a lot of things that look the same. But if you actually think about where the returns come from to generate that same outcome, it's vastly different. And that's why this element of transparency is so important. If you've got more leverage, more losses, higher fees, but the same return, you're actually just taking more risk. And that might be okay. If you want to be on that part of the spectrum I showed where you're at the higher end of risk because you're seeking higher returns, that's fine. But if you want to be on the lower end and you think you're there, but actually you're taking more risk, then that's a problem. And that's where the risk-adjusted return transparency comes in. Now, the final layer is a bit more complicated, and I think these slides will be available afterwards, so, there's I'll leave them with you. But there's a lot of things that go into good governance as a fund manager. It's things like the separation of teams, people who invest versus people who manage the portfolio as a fiduciary, and you want to have some degree of natural tension between them. You don't want people marking their own homework, so you want finance people, fund finance people, valuation people distinct from the people that are actually responsible for the risk at the book and responsible for the individual credit positions. You need external valuation review, external rating reviews. You need to be stress testing your book and disclosing that for what happens in different conditions. You also need to understand fees. That is, all fees should be disclosed, whether they're upfront or not, and you should be able to see the aggregate of this portfolio generates this total return, and this is how it gets to me as an investor. These things aren't new. As I said earlier, banks have been putting out good portfolio disclosure for a while. It's the same kind of thing that the industry in private credit needs to do. They need to put out disclosure around how things are structured, how they are structured as a business, how they structure their governance, how they actually operate their activity day to day in order to get you your outcome. And this is what investors need to demand. The final thing I think that investors should ask of a private credit manager is skin in the game. That is disclosure of how much the firm and staff at that business have invested in the portfolio. Because you can talk about all sorts of things around your protocol and your governance and so on, but if you're eating your own cooking, if you're invested too, you're probably going to be really focused on it. Incredibly, the last time there was a study on this was by BIS, was in June 2024, and they found that basically 40% of private credit funds featured not only a little bit, no skin in the game. So they're just playing with other people's money, and that's not a great place to be. Because it is a private markets alternative, and because you're lending, we're in the business of putting money out, getting it repaid, you actually want to have real investment. That's real skin in the game. So there's a lot here, and I wanted to provide a little bit of a checklist on this. I'll leave some time at the end for Q&A shortly. But the final checklist, if you think about these 3 layers of transparency, is essentially firstly, 1, what's the portfolio composition? Do I have sufficient visibility into the portfolio to make an independent assessment of what my exposure actually is? Do I really know it? Secondly, am I earning that private markets premium? Am I being sufficiently compensated above what I can get in liquid credit or another alternative for the risk I'm taking? Can I see the return per unit of risk? And finally, can I trust the manager to act as an empowered fiduciary? And that's where the structural and governance transparency comes in, making sure that they're aligned with the investors when they're making decisions and they have the right frameworks. And it's these 3 layers of transparency, from the most basic hygiene all the way down to the bottom, that are really the key decisions in being an allocator. I've never heard anyone pitch in any asset class, we have a totally undisciplined approach. We don't, we take heaps of risk. We're acting as cowboys, give us your money. Everyone always says that they act in a disciplined way, but it's disclosure about these things which enables you as allocators and investors to know. And that's really the key thing. So with that, there's a few minutes left. Happy to take any questions that there might be on the floor, or talk about anything that's out there, I guess, in the headlines. And there's a lot. I thought they might.
I've got his microphone.
Oh, yeah.
Oh, that's. First of all, thank you for the presentation. I've been waiting for that for some time, for someone to go through that. 2 questions. One, I haven't seen that level of disclosure in things that have been pitched to me. Is that a wish list by you, or does that exist? And secondly, just on the markings, like my understanding is that they kind of do it on a loss and event of default basis, so it's kind of a binary outcome. And because you get pitched a lot of numbers about, no, we don't have any defaults and all that kind of stuff. And I see you nodding, so I guess I'm onto something. Could you just talk to that a little bit, please?
Yeah, I'm going to answer the first one, which is there's a real spectrum. Certainly there are some people putting out disclosure like that. I think I know we do, I know there's others that do, that there are good managers that will. There are some that don't. And I'm not saying that they're bad, by the way. I'm just saying that they choose not to do that. I think that it's really important. I really don't buy the argument around, it's got to be all confidential and whatever. Like you can find a harmony between anonymizing enough and then providing investors the right information about what they've actually got, and it doesn't take away your IP. So I think it's becoming more important. Fortunately, there is a real push from the industry. There are 3 industry bodies creating industry standards here, actually post the ASIC report at 820 last year, which I think was a really good thing for the industry, and you're seeing a lot of work being done there. And there should be dialogue on it. I mean, investors should ask for things that they want to see, and hopefully over time things will keep improving as well. That's the nature of being a fiduciary, really. On the marking, there are different ways to mark. You can mark to market, you can mark to credit, meaning you can focus on when there's credit events. But really, you haven't done a good job marking your assets, whether you're marking to market or credit, if what happens is loans performing, 100 cents, bang, 0. Because most borrowers, unless there's been fraud, the borrower, and which hopefully you should be avoiding fraud, but most of the time, borrowers don't go from fully performing to 0. right? And we've seen a couple of examples of that. Things that were marked 100, now they're 0. So that's actually probably a feature of not the right governance protocols in place. Because if you had a segregated team performing your valuations and fund finance, you have an independent or at least a distinct valuation committee, a third party who reviews the carrying values of your assets, they're probably going to pick up that a distressed borrower exists and that they would be like looking at the valuation of that and testing it. So you shouldn't really see that on aggregate. Maybe if you saw it at the margins, sure, but you shouldn't see it in aggregate. The question, I think, for those in the room is, how do you know if that behavior is ongoing? And that's why I think you need those points of disclosure around amend and pretend. So am I amending positions to capitalize interest? Have positions been amended for covenant defaults? Are there non-accruals, not just impairments and markdowns? Those different types of disclosure points about the portfolio are red flags, and so it provides that real discussion point. There should also be performance-related disclosure around the loans, so that for things that aren't performing, there's at least an itemization of what they are, and it enables investors to have dialogue with their manager about what's actually happening. The fact that that disclosure is out there would also probably mean that the independent firms, the people reviewing carrying values on behalf of, well, as part of the fund framework, would also then be testing those. So I think they're the kind of things you want to see. And on both of your questions, there's just a wide spectrum.
I've got one to Nico.
Thanks, Frank, for explaining that subject matter in very simple terms. My question was, when you went on to the risk and assessing risk, there's multiple ways you can look at it.
Yeah.
Now, if you're in the equity space, there's some generally accepted principles of risk. One, standard deviation, beat up things that they're pretty transparent. Everyone gets it. Those in the private credit space, given there's so many different interpretations of risk, do you see, or can you comment, do you think we'll get to a point where there's a common measure of risk that advisors and investors can equally understand and they'll all get it? Or is it going to be sort of fractured into different definitions?
I think that you can look at it by asset class. So the key metrics in asset-backed lending are what's your credit enhancement, how are your arrears levels looking. If you were in direct asset lending, just take a loan to physical real estate, the key metric is your loan to value ratio. And even in loan to value, of course, what is V? Is it loan to value, progress value, cost? There's a whole bunch of things, but you can disclose those. And if it's corporate, it's what's my debt to EBITDA, what's my loan to value against the enterprise, how much debt service coverage do I have? So you can look at it by asset class. It's hard to come up with one specific measure of risk. You can also look at credit rating equivalents, performance scores. So it's not that there's one metric, but I provide the analogy of a bank balance sheet. If you're looking at not bank equities, but the balance sheet of a CBA, for example, what you're looking at is to try to say, what's the credit composition of that balance sheet? How are the loans performing? Specifically, how many of these loans are in arrears? And where they're in arrears, how well collateralized are they? Are they secured, asset-backed, they've got these defensive characteristics, or are they unsecured? And that's going to lead to some level of provisioning. And then that provisioning disclosure can be out there. So I think that you can have a consistent definition of arrears, defaults, and how impairments and provisions are recognized, which can enable investors to, in a simple way, compare across products. But when you're looking at any fund, you do need to go into a little bit more detail than just that.
Just one more question for me, Frank. I can't not take the opportunity, given that you're here to talk about US BDCs. You've touched on it a little bit. The big managers are obviously claiming the loans are good. Yes, we've got some exposure to software, but the companies we're lending to aren't affected by this. Clearly, there's a liquidity crunch going on. How do you see this kind of playing out? Is this going to be a self-reinforcing loop, or is there a circuit breaker where, predominantly retail investors who are pulling their money out will kind of stop doing that?
So I would say that I don't think that some of the use of the redemption gates that are happening by the the US managers is a bug. I think it's a feature of their products. They are semi-liquid products, and the idea of those gates is that they're not forced to fire sale assets, because if they go and fire sale them, it's not going to be a great outcome for investors. It's not in my interest to say that, because I should sit here and say, oh, yeah, those US managers come and invest with us in Australia or whatever, but I don't think that's actually the case. I do think that the big challenge being faced at the moment is not one of credit. That is, the loans aren't mostly performing, and certainly at some of the major managers, it is a confidence game issue. It's an issue of trust and investors understanding what they've got exposure to. I think disclosure around not just the liquidity terms of the fund, but the liquidity profile of the underlying assets is one of the things I had up there around the portfolio. What's the shape of it? When is cash coming back or not? Is important, and you'll see that come out here. I think one of the other big things that will come out of this is choice. So the approach we like to take is we offer unlisted funds that have certain terms, and it depends on the fund, but you'll be invested for a certain horizon, and then you have the ability to get out on certain terms, but it is limited to the assets being able to generate that liquidity. And then we offer liquid or listed ways to access the same thing, and there'll be a trade-off for that. There is a trade-off for daily liquidity, but there are ways to create that. So I think what you actually see is the industry create more things. And the final thing that will come out of this, I hope, is that people will recognize that private credit is not just sponsor-backed lending to one sector. It's actually a big spectrum, and the idea is if you were going to put your loans on deposit at a bank that only did one thing in one geography in one place, I think you'd probably think again about whether you have your deposits there, or at least above the government guaranteed level. We don't get that in private lending. You'd say, actually, I want a bank with a really diversified balance sheet, because they'll probably have the staying power for a cycle, and it's going to be the same thing in funds.
Perfect. Thank you very much.